Welcome back, students, to Accounting 2302, Managerial Accounting. This is Dr. Mercado with you. And in this lecture, we are going to be covering a problem from Chapter 25, which deals with differential analysis and product pricing. The problem that we are going to be working on today is problem 25-1A. Like a reminder every week, please make sure that you do read the chapter before you begin working on any of your homework assignments. That way you can become familiar with the content. Remember, you have the readings to complete, you've got the PowerPoints to review, you've got the lecture to listen to, and then you begin working on your assignments. That way you can have a better understanding of the content for the week. Okay, so let's look over the problem that we're going to be tackling today. So problem 25-1A deals with differential analysis involving opportunity cost. Okay, so the data states, on July the 1st, Campus Stores is considering either leasing a building and purchasing the necessary equipment to operate a retail store. Alternatively, the company could use the funds to invest in a $1.5 million of 2% U.S. Treasury bonds that mature in 15 years. The bonds can be purchased at face value. The following data has been assembled. The cost of the equipment, we're looking at $1.5 million. The life of the equipment is 15 years. The estimated residual value of the equipment after those 15 years is $75,000. The yearly cost to operate the store, excluding depreciation of the equipment, is $320,000. The yearly expected revenues, years 1 through 6, is $400,000 per year, and the yearly expected revenues, years 7 through 15, is $600,000 per year. Okay, so we've got all of the data that we need. Then we are being asked to prepare a differential analysis as of July the 1st, presenting the proposed operation of the store for the 15 years, alternative 1, as compared with investing in U.S. Treasury bonds, alternative 2. Okay, that is the first requirement we are going to tackle. Now, the textbook has a lot of specific differential analysis that will be completed. Okay, so I just decided to go over quickly what is differential analysis. So according to our textbook, this is coming straight out of the book, managerial decision making involves choosing between alternative courses of action. This is what management does all the time. They have to make decisions. A commonly used decision-making tool used in business is differential analysis. Differential analysis, sometimes called incremental analysis, analyzes differential revenues and costs in order to determine the different impact on profit of the two alternative courses in action. So we're comparing how much income are we going to be generating out of alternative 1, alternative 2, the same as with costs, and figure out what's going to happen. Okay. Differential revenue is the amount of increase or decrease in revenue that is expected from the course of action compared to the alternative. So the differential revenue is when we compare option 1 to 2, how much additional revenue would we generate off of it. Okay. Differential cost is the amount of increase or decrease in cost that is expected from a course of action as compared to the alternative. Differential profit or loss is the difference between the differential revenue and the differential cost. Differential profit indicates that a decision is expected to increase income, while a differential loss indicates the decision is expected to decrease income. Okay, so this is a quick overview of what we are doing. Okay, now in the specific problem, we are going to be doing the calculations for both options to figure out which is the best option for us. Should we open a retail store or should we just invest in treasury bonds? Okay, and that is what we're going to be working on. Okay, so I've already set it up. I've got my differential analysis title. We have to operate a retail store, that's alternative 1, or invest in bonds, that is alternative 2, and we are doing this differential analysis July the 1st. Okay, that is the date that is given to us. We are preparing this analysis as of July the 1st. And when we're preparing analysis or information to management, it always needs to be organized. So all we did is I created a column for my alternative 1, which is to operate a retail store. Then I'm going to compare that to my alternative 2, which is to invest in bonds. And then I'm going to calculate the difference between the options to figure out which one's a better option, if alternative 2 is better than alternative 1. Okay, so let's begin with our revenues. Okay, very important. How much money are we going to generate off of alternative 1 and alternative 2? Because that is super important. We need to know how much money we are going to be producing from each of those alternatives, okay? Now, I'm going to do my calculation down here. That way we see what the mathematics is all about and you can have it for reference, okay? So, according to the data, okay, where are we going to figure out how much income or how much revenue we're going to produce from the retail store, okay? And this is where it's very important that we understand what we are reading, okay? Sometimes students want, just plain information to be like provided to you, but the information is provided. We just need to dissect it from the problem, okay? So here we have yearly expected revenues, years 1 through 6, 400,000, and that's 400,000 per year. And then years 7 through 15, 600,000 per year, okay? So using that data, we're going to go ahead and we're going to do some math. Okay, so from years 1 through 6, that's a total of 6 years, okay? So we have 6 years, and we're going to multiply that by 400,000 per year, okay? And then I'm going to add from year 7 through year 5. How many years is that? So it's 7, 8, 9, 10, 11, 12, 13, 14, 15. That is 9 years, okay? And we're going to multiply those 90 years times 600,000. Okay. So then that will give us, let's see what it gives us. Let's get our calculators. So 6 years times 400,000 gives me $2.4 million. Okay. 2,400,000 for the first 6 years. And then I'm going to add, we've got 9 years at 600,000. That's going to give me $5.4 million. $5,400,000. So if we add the information, which is my 2,400,000 from years 1 through 6, plus my 5,400,000 from year 7 through 15, I didn't add that correctly. It's 2,400,000 right there, and then 5,400,000 there. Okay, so I should get $7,800,000 of expected revenues during that 15-year span. So it's $7.8 million. Okay, 7,800,000. There we go. So this is the calculation that we did. Okay. That way you can have it for reference, okay? 6 years at 400,000 plus 9 years at 600,000. So that gives me 2.4 million plus 5.4 million, giving me a total of 7,800,000. So that is my revenues that I am going to be producing if I open this retail store, okay? Now, let's figure out how much revenue I'm going to get if I invest in my bonds, okay? So let's do that one right there. Okay. Now for the bonds, the information is provided to you here. We are wanting to invest $1.5 million in 2% Treasury bonds maturing in 15 years. Okay. So we are going to get paid 2%. Okay. Or let's do, how much bonds are we buying? We're buying $1.5 million. Okay. Times 2%. Times how many years are we going to have this bond for? 15 years. Okay. Let me just, okay, so that way it's a little bit bigger for you. There we go. So we've got the $1.5 million that we're going to invest in those bonds. Okay. At 2%, that gives me 30,000 times 15 years. That gives me $450,000. So if we see here, the revenues that we are going to generate off of that investment in treasury bonds is going to be much lower, okay, than option or alternative 1, okay? So the differential analysis is going to be option 2, or alternative 2 minus alternative 1. Okay, and that gives me a significant difference. Okay, the differential effects of alternative 2 is $7,350,000 less in revenues than option 1. Okay, so if we're just looking at plain revenues, we would go with the retail store at this point because they are bringing in a lot more money than that investment in the bonds. But we're not done yet. We have costs to take into consideration. Okay, we've got costs. How much are we going to have to spend to produce that income, right? That's very important. So let's look at the cost for the retail store. Okay, so the data is provided to you here. So it says here that the yearly cost to operate the store, excluding depreciation, is $320,000. Okay, so let's do our calculation at the bottom. So now this one's the cost. So the problem says that we're going to spend $320,000 and we're going to have this retail store open for 15 years. Okay, so we're going to multiply $320,000 times 15 years. Okay, and that's going to give me $4.8 million. Okay. Okay. So my cost, I'm going to have cost to operate store is, and I'm going to put it in parentheses because this is money leaving the company. This is an outflow of cash, $4.8 million. So it's going to cost me $4.8 million to operate that retail store for the next 15 years. Okay. Now, do I have any costs associated with investing in bonds? We usually don't. You invest the money and that's it. Okay. There is no additional cost associated with that. So we're going to have here $0. So we're going to once again get alternative 2 minus alternative 1, and that's going to give me a positive. So if we look at the cost, alternative 2 is a better option because I'm not spending any money. And over here, if I open my retail store, I'm spending $4.8 million. Okay, so the differential effects of alternative 2 is a positive $4.8 million. Okay. Now there's one more thing that we need to consider for the operating of the retail store. We had to purchase equipment. Okay, that is just the operating cost. The $320,000 is operating cost, and it states that it excludes depreciation of the store equipment. So now we're going to do the cost of equipment less the residual value. The residual value, remember from financial accounting, it's basically the value that we are anticipating having, that we can sell this equipment at the end of the 15 years or at the end of the term, in this case 15 years. So the equipment that cost us $1.5 million, at the end of 15 years we can sell that piece of equipment for about $75,000. That is the residual value. Okay, so let's figure out the calculation of the cost of the equipment less the residual value. So I spend $1,500,000 on the piece of equipment, and I'm going to subtract the residual value because I am anticipating getting that back. My residual value is $75,000. So let's see what the calculator tells us. $1,500,000 minus $75,000. That gives me $1,425,000. That is how much I'm spending on my equipment. $1,425,000. Let me put that here. So we've got all of our formulas down here. That way we can be able to see how we arrived at each of the figures. Okay, I don't want you all being lost as to where we're getting this data. Everything is presented to you down here. Okay, did we buy any equipment for the investment of the bonds? No, no equipment is needed. Okay, so that would be 0. So let's get the differential effects for alternative 2. We're going to get option 2 minus option 1. And that's going to give me 1,425,000. Positive because option 2 is better. We're spending less money in option 2 that we are spending on option 1. Okay, so now is that's all we have. We've got the equipment, we've got the number of years, which is 15. We've got the residual value, $75,000, and we've already used up all of the data, so we're good. Now we can calculate the profit or loss from each of the alternatives. Okay, so let's underline this. Okay, so I'm basically just gonna add my total from the column down. Okay, so 7.8 million minus 4.8 million minus 1,425,000 gives me 1,575,000 in profit. Okay, that is what it gives me. Now let's do the same thing for the investment option. We're going to add your revenue less your expenses. We had a revenue of 450. We had no expenses whatsoever. It was a one-time deal. So the investment in bonds, alternative 2, is going to yield a profit of 450,000. And let's look at the differential. Let's see how different one option is from the other. Option 1 or alternative 1 is from alternative 2. So we've got a decrease of 1,125,000 in profit. Okay. Now this is the differential effects of alternative 2. If we take alternative 2, we're going to be losing 1,125,000 in potential profit. Okay. So these are the calculations. We've got our revenues, our costs, and our profit for each of the alternatives. That is what the requirement asks of us. Prepare a differential analysis presenting the proposal for alternative 1 and alternative 2. Okay, so that is requirement 1. Let me label it here. Requirement 1. Okay, so using the data provided, alternative 2 says, based on the results disclosed by the differential analysis, should the proposal be accepted? Okay. So, should we accept the proposal? What do you all think? Okay. So the proposal is, and this should be it too, should we open up that retail store? Okay. Remember it says the campus store is considering leasing a building and purchasing the necessary equipment to operate a retail store. Should they go with the leasing of the building and opening a retail store, or should they just get whatever money they have and invest it in a 2% treasury bond? Okay, so looking at the data provided, I don't know about you, but if I were a business owner, I would take the 1.575 million anytime over the $450,000. Okay, I am just gonna, yes, I have more costs associated, but that additional cost will result in greater revenues for me. So I would go, if I were the business owner or if I was the manager making this decision, the proposal to operate the retail store should be accepted. Based on our estimates, based on our numbers, you know what? It's going to give me a greater profit if I invest my money at the retail store than keeping it safe and just investing it in bonds. I'm not going to make a significant amount in my bonds over the 15-year span. I'm going to make a lot more in the retail store. So that is number 2. I would accept the proposal and open up that retail store. Now, if the proposal is accepted, what would be the total estimated operating income for the store for the 15 years? Well, we've already done all of the math, okay? If the proposal is accepted, we would be looking at, this is requirement number 3 here, okay? Let me put the 3 here. So requirement number 3 would be calculating the operating income. The operating income is your revenues less your expenses, which is what we have, and we would have operating income of 1,575,000. Okay, so if the proposal is accepted, what would be the estimated operating income for the store over the 15-year span? That would be, if we were to open it, we would have 1,575,000 operating income after or over the 15-year span of the business. Okay, so fairly straightforward. It's just as a matter of understanding the data, putting it together, assembling it in a way that it's easy and organized so we can be able to present the two alternatives and clearly explain, okay, these are your expected revenues, these are your expected costs associated for each of the alternatives, and then at the bottom we calculate the profit or loss for each of the alternatives. Using that information, then management can decide which alternative to use or go by based on the results of your analysis. Okay, so that is it for problem 25.1a. If you have questions, concerns as you're working these assignments, please do not hesitate to reach out to me. I am here to assist you in anything that I can. Please make sure to read. The textbook has wonderful information. The PowerPoints have great examples that you can refer to. Listen to my videos that explain some of the problems, and usually the problems that I am going over in these videos are the problems that you're going to be seeing on your exam. That is why I'm taking the time to go over them in detail with you and be as detailed as possible, so that way you can have good notes for when you are completing your assignments, okay, your exams. Okay, so that is basically it. Please make sure to keep up with your deadlines. Remember, most of your assignments for the weeks are due on Sundays. Please don't leave the completion of the assignments for the last day. Try to work on them during the week. That way you are not overwhelmed. And that is it. Until next time, have a wonderful rest of your day. Bye-bye.